Hello again, everyone. This is Chris Thomas, one of the mortgage experts. In this video, we will discuss the length of employment for miscellaneous types of income. This video will cover retirement, Social Security, capital gains, and other miscellaneous types of income. Rental income, hourly income, and salary income, commission income, and self-employed income are discussed in different videos. Stability and continuity of income are the two things that an underwriter looks at most carefully. You must document that income has been received for a certain period of time, and that depends on the type of income. There must be a likelihood of continued receipt of income for at least 3 years, and it's important to note that unless there is evidence that it will not continue for 3 years, the lender should conclude that the income will continue. For alimony or child support income, a divorce decree or other legal document must show that the income will continue for at least 3 years. The borrower must also document that full, regular, and timely payments have been made for the past 12 months. 6 to 12 months of alimony or child support is acceptable, provided that the income is not more than 30% of the total income that was used to qualify the borrower for the loan. Capital gains income is only acceptable if the borrower can document the following. The capital gains income has been received for the previous 2 years, and income tax returns are required. The income is then averaged over the past 2 years. The borrower must also document that they have additional property or assets that can be sold to make the mortgage payments. If they do not have additional property or assets, then the capital gains income they have already received is not allowed to qualify them for the loan. Disability income is allowed to qualify someone for a mortgage if the income will continue for at least 3 more years. If the borrower is currently receiving short-term disability income, which will be converted to long-term disability in the next 3 years, and the payments will decrease with the long-term disability, the lower long-term payments must be used to qualify them for the loan. Income from employment-related assets can be used to qualify someone for a loan. Here's some examples: a 401k, an IRA, a SEP, and a KEO retirement account. And we're talking about these accounts where the income is not currently being withdrawn. The assets must be available for withdrawal without penalty, meaning the borrower must be old enough to withdraw them. The assets must be owned individually by the borrower, unless the only other owner is the co-borrower. Only 70% of the assets can be counted, and the income is calculated as the total assets times 70% divided by 360. Here's an example. Let's say someone has $500,000 in assets. It would be calculated as $972 per month in income. You take the $500,000 times 70%, divide by 360 to get the income of $972, which can be used. Retirement, government annuity, Social Security, and pension income can also be used to qualify someone for a mortgage. The lender must document that the income is being received either by a W-2, a 1099, a retirement award letter, or something in that nature, and also they must document that the income will continue for at least 3 years. If a borrower has foreign income that they want to use to qualify for a mortgage, they must have received that income for the previous 2 years, and it must be converted into US dollars. Foster care income can also be used for a mortgage. The borrower must have received the income for the previous 2 years, as shown on their tax returns. 12 months is acceptable if the foster care income is not more than 30% of the total income used to qualify the borrower, and we must document that the income will continue at a level high enough to qualify for the mortgage. If a borrower has interest and dividend income they need to use to qualify for the loan, they must show that interest or dividend income was received for the previous 2 years, and then the income is averaged over the past 2 years. They must also show that it will continue for at least 3 more years. Non-occupying co-borrower income can also be used to qualify for a mortgage. The most common example is when parents buy a condo or some other type of property for their children. This is often referred to as a kiddie condo loan. The income from the non-occupying co-borrower is allowed with FHA loans. However, it is not allowed for conventional loans unless the occupying borrower can qualify by themselves without the income from the non-occupying co-borrower. The last type of miscellaneous income we'll discuss is tip income. Tip income can be used to qualify for a mortgage, but we must document that the income has been received for the previous 2 years. The tip income is then averaged over those last 2 years, and the borrower's employer must state that the tip income is likely to continue in the future. When you're looking for a mortgage, you need an expert. If you're a real estate agent and you've ever had a deal fall apart, it's time to start referring the mortgage experts to your clients. If you're a consumer looking to buy a house or refinance an existing mortgage, you need expert advice. Call us, Chris and Debbie Thomas, the mortgage experts, and you'll get the advice and the mortgage you deserve. If you'd like this tip, check out all the tips on our website. Tell everyone you know about the mortgage experts, and call us with any questions you might have.